recent economic data from that PMI print is supporting a hawkish potential move from the Fed. At least that's what we're seeing in terms of the pricing action here. Looking at the 5-year yield at 4.5%, a little above that right now. And weekly jobless claims also this morning changing that narrative a bit when it comes to yields. So here to discuss what the moves mean, we've got Sonal Desai, Chief Investment Officer at Franklin Templeton Fixed Income. Thank you so much for being here with us this morning. This PMI coming in hotter than expected. It's having a really big effect from my perspective on this market here. What do you think is the biggest thing that the market is moving off of from this print?
You know, it's not just the strength, it's also the fact that prices paid were somewhat stronger than people had hoped. So it's very easy, I think, right now for the market to get extremely excited by weak data, anything which points, we're still swinging around, trying to come to terms with the fact that the Fed is unlikely to cut more than one time this year in many just the number of data points they're going to need at this stage, it's too many to allow for more cuts. So, we're seeing some moves, but I think the market's gone a long way because previous to maybe a month and a half ago, you would have seen a much bigger move, I think, on this data.
So, Sonal, what does that tell us just in terms of the range that we'll likely see the yield? Because right now we have the 10-year yield right or at just below 4 or 5. Do you think we'll likely stay range bound around these levels?
Pretty much. I have, at the start of the year, I expect when I was asked for the range for the 10-year, 4.5 was right in the center of them, 4.5. And I don't have many reasons to change that view. I think it's 4.5. I think the Fed is going to have a relatively short and shallow cutting cycle. And I don't anticipate the short end going much below 4 because having a massive recession is not my baseline. I think at the background, what we really need to be prepared for is a short, shallow rate cutting cycle, but then after that, get prepared for higher long-term yields.
Well, back in March, former Dallas Fed President Robert Kaplan was on our program and was asked about his thoughts on inflation and fiscal spending and the relationship between those two. So I want to take a listen and get your thoughts.
The big cross current that I think the Fed is dealing with, and they may or may not want to acknowledge, is fiscal spending. Fiscal spending, I believe, is one of the big reasons the economy's been this resilient.
So I love this debate about whether or not monetary policy can outpace fiscal. And I know that you had a similar experience during your time at the IMF in terms of that debate between the two. So I'd love to hear your thoughts on what that relationship looks like.
So first of all, I could not agree with him more. Really, he could be paraphrasing exactly what I think. Because ultimately, if we take monetary policy in isolation, even without the fiscal spend, the Fed is working with monetary policy, which has very narrow channels to operate through. Because essentially, if I look at the biggest channel through which monetary policy would affect households, for example, it's through mortgages. Problem is that 85% of US mortgages were taken out at less than 3.5%. All these rate hikes really don't impact people who continue to hold homes. They're unlikely to move. Eventually, it's going to feed through, but it's a very, very narrow channel through which the Fed can actually influence consumer behavior. Certainly corporates, that's a separate issue, and we can talk to that. Fiscal, on the other hand, we have seen average budget deficits of 8% over the last 3-4 years. And if you look at those numbers at a time that the economy is not just growing, it is growing incredibly strongly, it has to come back to fiscal actually doing its part of what's going on with inflation and the strength of the underlying economy. It's also why, by the way, I think that longer term yields are not going back to the post-global financial crisis period of always being low, but to the pre-global financial crisis period when they averaged actually closer to 5 or above 5%. I'm talking about 10-year yields here.
Well, let's stay on that because that's a really important point. And I wonder how the fact that we are seeing a little bit more retail investor activity within the bond space impacts your view on that. Is that something that you think could lead to some more volatility in that view?
I think that ultimately fixed income does begin to play the role that it has historically played, which is ballast in the portfolio. You're not going to get those 6%, you're not going to get those double-digit returns that you get from equity from fixed income. The last several years have changed people's perceptions of what fixed income can and should deliver to a portfolio. It's supposed to be the ballast to equity. So the fact that retail investors are coming back into fixed income, this is a good thing because I think over a life cycle, there is space for fixed income in a portfolio. It's supposed to yield income, most importantly, and currently it's doing so, certainly more than we've seen in the last 15 years. And I think going forward, it will probably continue to do that.
Sonal, Desai, always great to get your insight. Thanks so much for joining us here this morning. Chief Investment Officer at Franklin Templeton Fixed Income. We appreciate it.